Hello, everyone. My name is Allie Johnson, and I'll be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Tammy Hoy, who is an attorney and partner at the Geller Law Group. She'll introduce herself and take us through a presentation on legal entity structures. Please feel free to ask questions using the Q&A function. We'll respond to them as we go along. And for any questions that we can't get to in today's session, please do send them to us in an email and we'll happily address them by connecting you with our no-cost one-on-one services or to resources that can help. I'll share a recording of this webinar and the slides as part of our follow-up email. So what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll go through the program overview, then on to eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses and nonprofits across Virginia build the systems and habits needed to become capital ready. This matters because businesses that are less prepared can often self-select out or fail their loan applications, and these early failures correlate to a lack of adequate capital. Additionally, higher cost alternatives often don't build long-term capacity, and ultimately only about half of the loan amounts that are requested actually reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply actually get their loans approved. So to help address this challenge, Capital Pathways has created a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible, you may ask? Any Virginia-based very small business and nonprofit at any stage who face challenges accessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. We start our process with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our program or other resources that can help. Under our legal structure validation, our in-house advisors can help answer and work through basic legal questions, and we partner with Tammy's law firm, the Geller Law Group, for help with more complex questions related to topics on business registration, trademarks, as well as contract and agreement reviews. We also offer financial webinars on topics such as financial basics, financial statement preparation, and QuickBooks training. Our one-on-one tailored advising support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, as well as loan readiness and lender preparation. As I said, the application readiness services is part of our individualized advising support, and we also offer webinars which cover topics such as what lenders look for in loan applications, as well as interactive mock loan interviews, SBA loan options, and sample application analyses. We also have a partnership with a lender who can provide one-on-one support to those looking for capital. Finally, our credit building advisor will help you review and interpret your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for the best financing options and terms possible. So if you're interested in getting started with Capital Pathways, you can reach out through our website at virginiasbdc.org/programs/capital-pathways, or you can contact me directly at capitalpathways@virginiasbdc.org. I'll go ahead and share my email and our website link in the chat for everyone to have. Now I'd like to shift over to introductions. As I said before, my name is Allie Johnson. I am today's moderator, and I serve as the Program and Intake Coordinator for the Capital Pathways program. My professional background is in economic development, small business support, and access to finance projects, both domestically and internationally. Our session today will consist of a 90-minute presentation. And again, please feel free to ask any questions throughout using the Q&A function. We'll respond to them as we go along. And if for any questions that we don't get to in today's session, please shoot us an email and we'll address them either through our no-cost one-on-one services or connect you with resources that can help. Additionally, I will share a recording of this webinar and slides in the follow-up email. I'd like to now pass things over to Tammy to introduce herself, tell us a bit about her background, and start the presentation.
Great, thanks, Allie. And hello, everyone. I hope you're staying cool in this very, very hot weather. I'm just going to share my slides, so just give me a moment. There we go, and I will launch. Oh, there we go. It's a little bit slow today. Okay, is that looking all right there, Allie?
Yes, looks good.
Yeah. Okay, great. Thank you. All right, so thank you everyone for joining us today. We're going to be talking about structuring your business for growth, and we'll talk about the various entity structures for small businesses and most of the common ones we see. We'll have time for questions at the end, but if you have questions throughout, we're happy to have this be a more interactive conversation today. And so we welcome your questions. And as Ellie said, my name is Tammy Hoy. I am a partner at the Geller Law Group, and I chair the business law practice there. We serve small business and nonprofit clients in the DC, Maryland, and Virginia area. So a lot of what I say can also apply to other jurisdictions in the DMV as well. If you have a particular question about something outside of Virginia, we can also help with that. But we're very happy to be partnered with Virginia SBDC and Capital Pathways specifically. We've had the opportunity to talk with some Capital Pathways program participants and help them with some of their legal questions. So we're always happy to partner with Capital Pathways to help folks who wouldn't otherwise be able to get the help that they need. I'm most of my practice is going to be in the small business. With small businesses in this area, we serve all types of businesses, consultants, restaurants, retail, healthcare. So we have a pretty wide-ranging practice, and we just serve as outside counsel to a lot of our small business clients. Of course, as an attorney, I do need to make a disclaimer. This presentation is for informational purposes only, and it's not intended to convey or constitute legal advice. It doesn't create an attorney-client relationship. If you do want one, we would enter into an engagement. It is not intended as a solicitation or all-inclusive statement of the law, and it's not a substitute for obtaining legal advice from an attorney or tax advice from a qualified CPA on your specific situation. All right, now that that's out of the way, we can talk about who this webinar is for. It's for small business owners who are kind of beyond the startup phase and planning to scale or take on partners. It could be for owners seeking financing or stronger legal foundations and other small and growth-ready businesses. So this is a pretty broad scope, and we're glad to see everyone here today. And this is just a brief outline of what we'll be covering. We're going to spend some time on talking about business entity choice and why it matters, and then some other items like ownership agreement, liability and risk management, transitioning as you grow, and lenders and investors, what they're looking for, and perhaps some, if we have time, real world growth scenarios. We'll sum it up with some key takeaways, and we'll have a few minutes at the end for additional Q&A. All right, so jumping right into business entity choice. This is the foundation for your legal business. And we'll first talk about why business structure matters. There are a few perhaps obvious things, but if you're new to business, you might not have thought how these necessarily apply to you. So legal structure can impact your liability protection. There's different protections based on the legal entity type that you choose to operate as. It can also have tax consequences, which we all have an interest in minimizing tax impacts that might, take money out of our pocket. So, um, knowing what those different structures are and how it impacts taxes is going to be important. With different business entity structures, you can also have different ownership and control rules. They might be related to the statute and how for that business entity type and how ownership and control is exercised. And it could also be affected by your ownership agreements. And then your business structure might also affect your ability to raise capital. We'll talk about this a little more later. The right structure ultimately can support your long-term growth. Oops. Here is just a list of common business entity types that you'll find in pretty much every jurisdiction in the US. You have your sole proprietorships, which is just one person. You can have general partnership, and there are other flavors of partnerships as well. In Virginia, you can have a limited partnership, a limited liability partnership. We also have limited liability companies, which is a little bit newer of an entity structure, or rather business entity type. It was conceived of in the 1980s, which, I was alive at that time, so I don't feel like it's that old. It's relatively new compared to corporations, which is down at the bottom. You can also have a cooperative association. I don't personally deal with those as much in my practice, but they are out there, and it is an option for a business entity structure. You also have non-stock corporations. Other jurisdictions like DC calls this a nonprofit corporation, but it's essentially the same thing. We won't be touching on those necessarily today, because that is a whole other type of uh, business entity, and it has a lot of other implications if you do want to operate as a non-stock or nonprofit corporation. So we're sticking to the for-profit structures today. This is a comparison chart, and I know there's a lot of words on this, and it's very tiny. You will get a copy of this when Allie sends out the slides at the end of the presentation, but I'm just going to kind of give you the lay of the land here. So, down the left-hand column in the dark gray boxes, those are different characteristics of the business entity types. And then across the top in the kind of turquoisey, teal, or what would you call that? I'm just going to go turquoise. Color is the different business entity types, and they go from left to right, the simplest form to the most complex form. And we're not going to talk about every thing in depth while we're on this page, but it just compares the different characteristics across the different entity types. So ownership, and who the owners are, and characteristics of ownership for each entity type, owner liability, whether it's separately taxable as an entity from its owner or owners. And there could be different tax treatments at the federal level and at the state level, depending on the entity type. The next category is whether registration is required. And then also, if the man and another category is the management of the business and who manages the business, depending on the different entity structure. And then this chart also talks about capital contributions and who those typically come from. Also, before I move on, one thing to note is that the terminology for um, a particular concept might be different depending on the different entity types. So, if I bounce around to different terminologies, they might be referring to the same thing. For example, ownership, for sole proprietors, proprietorships, you sometimes will call them the sole proprietor or an owner. It's pretty straightforward. Partnerships, you call the owners partners. In a limited liability company, the owners are called members. And then if for a corporation, the owners are called shareholders. So it's kind of the same concept across these entities, but the terminology is going to be different. And that kind of applies to the different categories as well. There's different terms for different things that kind of serve the same purpose for the different entity types. They're just called something different. So a sole proprietorship, starting with the most simple type of entity, is a business that is owned by a single person. There's no registration required to create the business, and it's set up simply by beginning to do business. You can offer goods and services, and you're essentially a sole proprietorship. Um, if you are operating using a business other than your own legal name, you should register a fictitious name. That's how what it's called in Virginia. In DC, it's called a trade name, or a doing business as name. Those are different terms for the same thing. And the reason for this is so that consumers are aware of who is behind the business if you're not using your own name. Um, the income from your business is reported on your personal income tax return. So this is what's known as a pass-through entity because the income from your business will pass through onto your personal income tax returns. Um, for a sole proprietorship, the benefits are that it is easy and relatively low cost to set up and operate. You just start doing business. And then, of course, you have 100% control over the business. You make all the decisions. You are it. The cons, and I think this is a pretty big downside to sole proprietorships, is that there's unlimited personal liability for your business activities. So as a sole proprietorship, there's no separation between your business activities and your personal activities. It's all in one bucket. So what that means is, if there's any sort of claims or issues with respect to your business, all of your personal assets could be at risk because it's all in one bucket. So that is pretty big downside to operating as a sole proprietorship. A partnership is kind of the next level up on that chart in terms of complexity. It's a business that is owned by two or more people. No registration is required to create the business, similar to the sole proprietorship. And you just set up the business by beginning to do business, offering goods or services to the market.
Sorry, Tammy,
In
you cut
Virginia,
out there for a minute,
okay.
where you
Oh,
said
sorry.
business is owned by two or more people.
Okay. Thank you, Allie. So it's similar to a sole proprietorship in the sense that no registration is required to create the business. You set it up just by simply beginning to do business, offering goods or services to customers. In Virginia, you may file a statement of partnership with the Virginia State Corporation Commission, which is the registry where you register your business. It just is kind of a certificate of existence. You tell the Corporation Commission that you're operating as a business partnership. It's not mandatory, but you can. And then similar to a sole proprietorship, if you are operating with a business name that is other than your legal names. And usually, if you're working with somebody else, you will come up with a business name, and you'll have to register that name as a fictitious name with the Virginia Corporation Commission. And then, in terms of income tax and how it is taxed, it is the same as the sole proprietorship. In the sense that it is a pass-through, and whatever portion each partner gets allocated in terms of the business income, that portion gets reported on each partner's respective personal tax returns. There are, as I mentioned before, different types of partnerships. A general partnership is kind of the default. There's unlimited liability for all of the partners. There are different types of partnerships as well, like the limited partnership, where liability is limited for the limited partners, but unlimited for the general partners. And then there is another type of partnership, which is a limited liability partnership, where everybody is a limited partner and there are no general partners. Um, I'm going to talk about general partnerships with respect to this chart. So, for general partnerships, they're like sole proprietorships, easy and relatively low cost to set up and operate. You just start doing business. Um, And then, similar to a sole proprietorship, there is unlimited personal liability for business activities for general partners. So essentially, everything is in the same bucket. Your business activities and your personal activities are kind of lumped together. And another downside of a partnership, if you have a general partnership, is that partners can bind other partners to business decisions. And, if something were to go wrong, all the partners would be held responsible, including for the malpractice or negligence of other partners. And it depends on the line of work that you're in, of course. And so now we're going to the more complex or the most complex type of business entity, which is a corporation. We'll get back to the middle part after this, but we started talking about the most simple, and now we're talking about the most complex, which is a corporation. A corporation is a legal entity separate and distinct from its owners. So once you create it, it's alive and it has its own kind of life. It is incorporated and registered. That means formed under the state law by filing articles of incorporation. The owners are called shareholders who own shares of the corporation, and the corporation itself files its own tax return. The pros of having a business entity structure that is a corporation is that personal liability protection for shareholders is separated from personal liability of the shareholders. So by creating this separate legal entity, you're putting all of your business and activities into a separate bucket from all of your personal assets. Um, the downside of a corporation is that it is more expensive to start and maintain. And it's a pretty complex governance structure compared to a sole proprietorship, partnership, or an LLC. There's a whole statute for corporations, and it tells you that you need to have shareholders. And so that's one level of governance. And then you have to have a board of directors, which is another level of governance. And there are also more corporate formalities to observe. The statute will say that you have to have your annual meetings as a board of directors, and it will kind of it requires you to have meeting minutes. Because it's a separate entity, you need to treat it as a separate entity, and all of the affairs of the corporation need to be memorialized in the meeting minutes and the books of the corporation. And then lastly, at least on this slide, is the double taxation. So if you are a shareholder, uh, rather, I mentioned on the previous slide that the corporation will file its own tax returns. And then if it issues any sort of dividends to the shareholders, then that is income to the shareholders, and the shareholders need to report that income from the dividends on their tax returns at the owner level. So this is what's known as double taxation. So at the corporate level and the shareholder level. Um, Now we're going to talk about limited liability companies. And as I mentioned earlier, this is a newer type of entity compared to the others. And it is what I think of as a hybrid type entity because it takes some characteristics of the sole proprietor and partnerships, and then it takes characteristics of the corporation and it mashes them into one type of entity. And so this has created a very flexible type of entity. It is a legal entity separate and distinct from its owners. So you create an LLC by registering and forming it under state law by filing articles of organization. The owners of an LLC are called members and they own membership interests in the LLC. You can have a single member LLC or a multi-member LLC. So it's not limited to, more than one person. Um, or excuse me, it's not limited to just oh yeah, more than one person. You can have an LLC as just a single person, and that's perfectly fine. So it combines the liability protection of a corporation because you have this separate legal entity, and then it also adds in the pass-through taxation of a sole proprietorship or partnership. So if you have created an LLC, the default tax classification of the LLC is, however, the owners are taxed. So income is reported on the member's personal income tax returns. The pros of the LLC entity structure are, of course, the personal liability. Once you create the LLC, you separate your business activities and assets from your personal. So you have two buckets. It's no longer one bucket where, business activities can affect your personal assets. So that's a really big plus. It is less to start and maintain than a corporation. It is a very flexible business structure and management structure compared to a corporation. A lot of it is handled through written agreements rather than set forth in the structure, excuse me, in the statute. Um, and then, so there are fewer corporate formalities. And then you also can choose your tax classification. So the default is however your owners are taxed. So if you're one person who is the member of the LLC, then it's taxed as a sole proprietor. If it's two or more, the default taxation is a partnership. But you can also elect to tax the LLC as an S corporation or a C corporation, and I'll get to those classifications in a little bit. Um, Honestly, the cons in terms of an LLC, there aren't as many. It is more cost to start and maintain than a sole proprietorship or a partnership, but I think this con is outweighed by the liability protection that you get from the LLC entity structure. So here's just a little slide on tax classification and business entity type. So it can be confusing because the same terminology is used to describe categories in both um, types of things. So this little chart kind of tells you whether it is a business entity type or tax classification. So sole proprietorship, that's both a business entity type and a tax classification. Same with partnership. Where it gets a little bit tricky is the limited liability company and the S corporation. So limited liability company is a business entity type, but it's not a tax classification in terms of in the eyes of the IRS. Um, and then S corporations, it's not actually a business entity type, so you can't form a business entity type. It is a tax classification, so you have to have an entity type. So usually that's either an LLC or a corporation, and then you elect to be taxed as an S corporation. So it's not a business entity type, it is a tax classification. And then corporation's pretty straightforward. It's business entity type and a tax classification. So as I've mentioned, LLCs are taxed according to their ownership, and have a lot of flexibility in how it is going to be taxed. And another thing to note is that treatment of tax terminology and treatment might be different at the federal level from at the state level. So at state level, the terminology is usually called a pass-through entity, whereas at the federal level, it's a disregarded entity. So if you see those terms, you kind of know what level of tax you're talking about. Um, and then also at the state level, sometimes states, DC doesn't recognize an S corporation tax classification. So everything is, it's there, you have to do your taxes a little bit differently in DC with respect to S corporations. Um, all right. So here's a little bit more about the S corporation election. Um, S corporations are small business corporations that elect to pass corporate income losses and deductions, et cetera, to their shareholders for federal purposes. Um, so it becomes a flow-through entity of income and losses. And if you are a corporation and set up as a corporation, this changes things because you no longer have to file your own tax return as a corporation. Um, there are certain requirements for in order to make this election as a S corporation. It has to be a domestic corporation or other eligible business entity. So it has to be a domestic LLC or something else that's eligible. You can only have whatever the allowable shareholders are. There are some citizenship requirements. Um, the shareholders, maybe individuals, certain trusts and estates. It can't be other entities generally, but there are some exceptions. Um, so here, it, as I just stated, it can't be a partnership or corporation. Non-resident alien shareholders don't love the term alien, but it is an immigration term. So that's where the citizenship requirement comes in. And then to be a small business corporation, you cannot have more than 100 shareholders. And then another requirement is that it can only have one class of stock. You can have voting and non-voting stock, but all of the economic rights need to be the same across shareholders. And then certain financial institutions and insurance companies and other types of companies are specifically not eligible to be an S corporation. Um, and in order to make this election, you file Form 2553 um, with the IRS. And there are certain time frames where you need to file by. If you can elect to be taxed as an S corporation after operating it for a certain number of years, but just know that your S corporation election, once you make it in a given year, it starts for that tax year. So if you made it in like February, you have to kind of go back to January and um, redo your bookkeeping as an S corporation. So I'm just going to pause there and see if there are any questions before we move on to the next section. Allie? Do we have anything?
Yes, we do.
Okay.
So we have two questions. First one is if you start as a single member LLC, are you able to change to a multi-member LLC?
Yes. Great question. And this kind of applies for almost all of the business entity types except for the non-stock ones. I mean, you can convert your entity from an LLC to a corporation, but certainly as a single member LLC, you are still an LLC. You can just or withdraw any members as you want. It might require technically, if you change your tax status, the IRS wants you to get a new EIN. So there could be some other implications, but you absolutely can change from a single member LLC to a multi-member LLC.
Thank you. Next question is a clarification question. Confirming that an S Corp shareholder can be a citizen or a legal permanent resident.
Yes, that is
Wonderful.
correct.
And then what is the benefit of choosing an S Corp LLC versus a sole proprietor LLC?
That is a great question. And I usually will defer to accountants on this question. There's no, black and white answer. It's going to vary depending on your specific circumstances. Some of it, if you're looking at, the tax implications of each, one of the things that you should know about if an S corporation election is that all of the owners, if they are working for the company, need to be paid as W-2 employees. So it kind of separates if you were default, treated as a default, taxed as a default LLC, your owners do not need to be paid as a W-2 employee. You can just take owner's draws and distributions as you can as an owner. If you have money in the company and you want to take an owner's draw, you can do that. Um, S corporation means that you pay yourself as a W-2 employee for the meaningful work that you do, services that you provide to the company, and then it separates you from, the ownership hat. So you can still, pay out distributions to owners, but that's it's different. So your tax result is going to be you're going to be taxed personally on your W-2 income. And then if you take draws and distributions from the company as an owner, that's also taxed as a different rate. So cumulatively, you might have a different tax result from being taxed as an S corporation than if you were just being taxed as a default tax entity. So this is going to a certain extent, depend on how much revenue you have as an entity, as a company. And it also could depend on, how many other owners you have, how many employees you have, all of those things. So it's really going to depend on your numbers as to, what is going to be a net benefit for you in terms of, on the tax side. So that's one of the aspects to think about. And then the other thing is, in terms of governance and ownership, you have to have only one class of stock as an S corporation. So, if you wanted to have different economic rights for the shareholders, like common stock or preferred stock, you can't do that with an S corporation. It's all the same. So that's also kind of a big can of worms. So it really depends on your situation. But those are kind of, two examples as far as like common things to think about if you were to make or consider making an S corporation election.
Thank you. I have the next question is additionally, or another clarification question rather, between LLC and S-Corp. Just want to check with the question asker if Tammy has answered your question. If you could give me a thumbs up or something in the chat to say yes, or in the Q&A to say yes or no, we've answered your question. And I will, in the meantime, move on to the next question. Question asker has a business that is registered as an LLC and elected as an S Corp, and they are two members of the business. Are they on the right track?
That is a very general question, because whether or not you should be elected as an S corporation, as I um, just explained, will depend on a lot of different factors. It could be right for you. But having a business entity registered at all is a great idea, because that helps you with liability protection for your personal assets. So, not knowing anything else, it sounds great.
Thanks. And if that question asker has further questions about their specific situation, please do shoot us an email about that. We're happy to help suss that out and identify if there's maybe some changes you need to make or if you're in good shape. Next question. Which between a C Corp or an S Corp gives you protections? I'm assuming this is in reference to tax protections or liability protections.
Yeah, so in terms of entity, because, and I'll go back to the slide here. Um, oh, here, this one. Uh, the you would form as usually either a corporation or an LLC as the business entity type. Um, so if you were a corporation, you could either be taxed as a corporation or elect to be taxed as an S corporation. So if you are taxed as a corporation, then the corporation files its own tax returns. Um, However, if you're taxed as an S corporation, it becomes a little bit simpler in terms of the tax filings. And I am not an accountant, so that's as far as I can kind of take that question. But in terms of liability, because the S corporation is not a business entity type, it doesn't really give you any sort of liability protection. It's just a tax classification. So the implications are all going to be on the tax side, which I would defer to an accountant to answer, and then also it'll also depend on your specific situation with respect to benefits of one over the other.
Thank you. Next question. If you have an LLC in a different state but do business in Virginia, so have a DBA in Virginia, What would be the best way to convert or dissolve your LLC in that state to create something around your DBA?
Okay. So if you're always going to have you're a domestic state, which is the state where you were formed. So it could be in Virginia, it could be DC or Maryland or any other state in the country. And then if you are actually operating from in another state, you typically would need to foreign register in that state. So it's a little bit more than a DBA, but it's a well, I typically call it a foreign registration. States will have certain laws about it's either conversion or domestication, and different states will call it different things, but it means the same thing. It's can I move this LLC that I created in state A into state B and have it just kind of move and remain intact. And for the most part, if both states have a statute that allow that kind of moving from one state to another, it's usually a conversion or domestication statute, then you can do that. I do know of one state that doesn't do that, and it's Georgia. So if you are originally formed in Georgia and want to move that LLC into Virginia, you can't do it in one step. There are other ways, like a merger, where you can like create a new entity and then merge that Georgia entity into the Virginia entity, and it still have the Virginia entity survive. But for the most part, you can move one entity from one state to another by converting it. And you file, there's articles of conversion that you would file. So once you convert it into the new state that you want to go to, then you have to go back to the old state and say, okay, I'm no longer here. And you basically, there's a form you file in your original state to withdraw the LLC and tell them that you've moved to another state.
Thank you. And to the question asker's second part of their question about whether their entity would be considered a nonprofit or a for-profit business, that is a great question to ask to speak with one of our business advisors about because Capital Pathways, unlike the SBDC, is able to work with both for-profit businesses and nonprofits. So please do reach out to us and we can see what we can do to help. We've got one more question in the queue, and then I think we can continue on with the slides. Should you establish several LLCs to limit liability if you have, for example, several different rental properties in order to limit your liability exposure on each property?
That is a great question. I typically, when we advise clients who have multiple rental properties, we do advise them to have separate LLCs if they want to have a rental LLC at all. But if you're going to do it, then um, the best practice would be to have a separate LLC for each. And the reason is that if you have all of your rental properties in one LLC, if an issue came up with rental property A, and unfortunately, there's a lawsuit and you are found liable, then all of the assets of that LLC are subject to that judgment. And so if you have property B, C, and D in there, those assets can be used to satisfy that judgment if, it exceeds anything that you have in terms of property A. Any income that you have from the LLC, from all of those properties are going to be in that LLC as well. So, if you're going to have, I mean, having that one that holds all of them does separate it from your personal assets. So that's great. But a better practice would be to have each LLC in a hold a separate rental property. You'll need to do this if the rental property is in a different state because the LLC should kind of match where the LLC, or excuse me, the property is situated in. And yeah, so I would recommend it, but whether that is administratively feasible to maintain on your end is also kind of up to you. But it would be a best practice.
Thank you, Tammy. I think we can continue on with the next
All right.
section.
Great. Thanks, Ellie. Thanks for all the questions, everyone. These are great. So in terms of that your business entity structure, that's the foundation. And I kind of alluded to this earlier is that, you can start off with one business entity type and evolve, uh, and you might need to change into a different entity type, and that's okay, and that happens all the time. So once if you choose something at the outset, you're not stuck with it for the life of the business. It can evolve and change over time. So in terms of getting ready to, expand or for financing or for investments, we're going to talk about a few things that often come up and are important to have. Um, because if you are looking at any of those things, you want to make sure your house is in order. So one of the important things to have, especially if you have business partners, two or more people involved in the business and who have ownership in the business, you should have an ownership agreement. Um, so these agreements will be among the owners of the business and govern the relationships and rights of each owner with respect to the business and how it's going to operate. For an LLC, this type of agreement is the operating agreement. Some jurisdictions call it the LLC agreement. It's the same thing. Um, in for a corporation, it's a shareholder agreement. You also have bylaws, which are kind of the foundation of, how the corporation is going to be governed. But the shareholder agreement is an agreement among the shareholders themselves, kind of built on top of the bylaws. And then if you have a partnership, you would have a partnership agreement. Just circling back to the operating agreement, uh, it's not mandatory to have one. So if you're a single member LLC, you don't have to have one. But some banks require you to have an operating agreement in order to open up a bank account. An operating agreement can also help you with, to some extent, your succession plan for the business. We often help people put provisions into their operating agreement to transfer the membership interests upon their death to whoever they want it to go to. So that's another, thing that you can do in your operating agreement that's a helpful tool. Um, In any event, your operating agreements are going to help define rights and responsibilities of the owners, set forth how the business is managed, set forth rules for financing, procedures for exit and entry into and out of the company. And then it'll address scenarios like death, disability, or just a withdrawal or separation of an owner from the business. It helps prevent disputes and it can help protect relationships in businesses and the business itself by having all of these things kind of set forth. And so everybody's kind of clear on how things would happen. It can also have, dispute resolution provisions. The best time to enter into an ownership agreement is kind of at the outset, and you hash it all out. Don't wait till something goes wrong until you have an ownership agreement or like figure out how you're going to resolve disputes or anything like that, or if somebody wants to leave, because then you might have different ideas of how things are going to go. Talking out, and the exercise of going through and setting forth these ownership agreements is going to be really important in the long run. So in terms of liability protection and risk management, we've already talked about how business entity structure affects personal liability. There are also some common mistakes that weaken protection, and they usually center around not respecting the separateness of the business entity. So, if you have a separate business entity like an LLC, you want to make sure that all of the affairs of the LLC are run through the LLC. So the LLC will have its own bank accounts that are opened with the federal employer identification number, that's tax ID, that it has all of the insurance policies are under the LLC. Any contracts that are entered into are in the name of the LLC. That way, everything is contained in there. You do not want to be commingling funds from your personal funds, credit cards, things like that, with anything to do with the LLC. They should be kept separately. And, the book should be kept separately. And then at the end of the tax year, you fill out a separate schedule on your tax returns for your business activities. It's not mixed in with any W-2 income that you might have. So it needs to be contained in its own little world, so to speak. So it's really important to keep them separate and maintain that separateness. For an LLC, for a corporation, anything that is a separate legal entity, from yourself, having that um, entity formed is not necessarily going to protect you from liability if you're not actually abiding by it. Um, and then the other thing is that um, people might not realize that once they create an entity, that they need to maintain that entity. And sometimes we'll see, first time business owners, they don't realize that they have to file, annual filings to keep their business entity in good standing. So it lapses and then, it might get administratively revoked, which means you don't have that liability protection anymore. And I've actually seen this with corporations as well. And I've seen it where people operate for years and don't even realize that their business entity doesn't even exist anymore, which is a little bit scary. After 5 years in Virginia, if it's lapsed and has been administratively dissolved for 5 years, you're not able to reinstate it. But if it's within that window, you can still reinstate your entity, which is really great news. It's a pretty generous window for you to go back and file all of your annual reports. Um, and then lastly here is the importance of proper documentation and compliance. So, especially with a corporation where there are a lot of corporate formalities, it is important to keep those up and treat it as the type of entity that you've created. So if you have a corporation, you need to have your shareholders, your board of directors, you need to have your corporate books for meeting minutes, resolutions, major actions that are taken by either the shareholders or board of directors on behalf of the corporation. So that is all in place. And then not only that, but like maintaining and keeping on top of all of your filings that need to happen, of the administrative filings that need to happen. So I mentioned the corporate registration, but things like taxes, business licenses, all of those things that, make or ensure that you're in compliance with all of those regulatory items, in terms of keeping the business alive and healthy. Um, Transitioning as you grow. So, there are certain things that might happen where you might need to change your entity type. Somebody asked a question earlier about, can I add a member to a single member LLC? Yes, of course. You can add business partners. That might change your entity type. If you are a sole proprietor, if you add a business owner, then you become a partnership. Um, so there are common transitions. You could operate for a while as an LLC that is taxed as a pass-through. But then at some point it makes sense. I mentioned that as an S corporation, you need to pay yourself as a W-2 employee, once you make that election. So in order to do that, you need to have enough recurring revenue in order to pay yourself a regular salary, let's say. So at the startup phase, it might not make sense to be taxed as an S corporation right off the gate, right out of the gate. A lot of businesses will operate as a default taxed LLC for a number of years. And then, in consultation with their accountant, when it makes sense, they might elect to be taxed as an S corporation like the following tax year, in order to save on taxes, for example. So that could be a transition. And then we already talked about the single member to multi-member. And then there are, of course, legal and tax considerations for any types of transitions from, one entity type to another. And we've kind of already talked about, the differences between the entities. Um, if you were to transition from an LLC to a corporation, There are certainly legal implications of that. You're now subject to a lot more complex and more corporate formalities. And so you have to get those things in place. And then, of course, the considerations we've already kind of covered, but you kind of get the gist of it there. If you're looking at borrowing money or getting investments, usually, whoever is potentially lending you money or potentially investing money in your business will conduct due diligence. So they're going to want to make sure that the company is organized appropriately and that they're going to look at capital structure, any regulatory requirements of the business. This is outside, just basic licensing for, a general operating business. So if you were in the food and beverage type business, there's going to be, regulation about the health and safety for the food. If you're a childcare business, you also have additional regulatory requirements to meet in terms of safety for having a childcare organization. And then financial information, making sure that you have your books in order, that you've filed your tax information. Um, I would say, for new entrepreneurs or entrepreneurs that are kind of, usually the financial piece is a really big learning curve. So, getting information on, and how to understand your books, that's going to be really important. Um, and then they'll also look at contracts. How are you making money? How are you, what kind of vendors you have and what your contracts say. And then, in terms of contracts, are they, well written? Are they protective of the business? What your employment practices are, if you have taken the steps to protect your intellectual property, what real or personal property that the business might have. So real property is of, buildings and land. Personal property might be equipment that you use in the course of, providing services or producing goods that you sell through the business. What your insurance policies look like, whether there is any sort of litigation or potential litigation, and what your compliance with laws are. So these are the things that anybody looking to put money into your business are going to look for. Um, there are some, preferences in terms of entity structure that an investor might want. A lot of times, investors, and you might have heard this in certain contexts, investors would prefer to invest in a corporation rather than an LLC. And I've also seen corporations, or excuse me, investors require um, companies to be domesticated in Delaware, um, as opposed to um, wherever they are created originally. I had a client who was on Shark Tank and got an investment from Mark Cuban, and one of the requirements was that they convert to a Delaware entity and they convert to a corporation because they were a Maryland LLC. So that is, the preference is for a corporation because there's more certainty in terms of the capital structure that investors like. But normally, I wouldn't necessarily do that ahead of time unless you have, deal terms from an investor. So I wouldn't do that preemptively unless, you had other reasons to do it. Um, red flags on any of these items, due diligence items listed here can potentially derail um, funding or like a loan or investors. I'm currently in the middle of a, a loan closing, an SBA loan closing, and there are a lot of documents that the SBA is requiring, or rather the SBA lender is requiring in order to get this closing done. And if you aren't kind of in good order already and can produce these documents, you're gonna have to, it's a lot of time to get things in order before you even like get to the closing. Um, so having a lot of these in order kind of on an ongoing basis is going to help you if you get to that stage where you want to approach lenders or investors for funding. Um, so there are other scenarios other than, requiring money is, um, in order to kind of, uh, where you're kind of forced to grow or you are growing. You're scaling operations, you're having to hire more people or having to produce more product. But they all kind of tie hand in hand. If you need to produce more products, you might need to either, get the machinery to do it or get the people to do it or both. Um, and then if you are, a service provider and you are always busy and you need more capacity, you do need to, hire more. Bringing on partners, bringing on, additional lines of business, if you're preparing for loans or investments or um, anything like that. It might require you to just reevaluate your structure and whether it works, and it will continue working for you in the long run, or at least, for your medium term goals. Anytime you add an owner or you're looking to grow in a certain way, if you want to provide equity incentives to your employees, those are times where that's going to affect your corporate structure and governance documents. And so those are, all of those operating agreements and owner agreements, I view those as living documents. They're not static. They are going to have to grow and adapt with you over time in the course of your business. So, um, it's a good idea to do periodic, perhaps annual checkups on how you are doing in terms of all of these things that we've talked about. Because when the time comes that you want to grow or bring on partners or get funding, these bits of information are going to help inform decisions, but it also is going to help you kind of get there quicker if they're all in order already because you've been maintaining them appropriately. All right, oh, I guess I can do the key takeaways and then we'll pause for more questions. So, key takeaways, structure is a strategic growth decision. You can start off with one type of entity type, and then change over time. And that's perfectly fine and common, for that to happen. Ownership agreements and legal compliance, with your entity structure are essential. And you do also have uh, an ability to plan ahead for financing and partnerships. And more often than not, those types of things take longer than we want them to in terms of preparing for those things. So, looking forward at your business, where do you want to go from where you are? What's your 5-year plan? What's your 10-year plan or vision? Where do you want to be? And so kind of work backward from what that vision looks like to you or could look like to you, and then plan backwards to where you are today. Um, and you can kind of start getting ready for that. One of my clients, she says, I want to sell the business in 2 to 3 years. So we're already starting to plan for that. Just kind of making sure that everything is in place for that to happen. And so, if she were to sell the whole business wholesale, this is, she had a name for the business that she actually wanted to keep for herself because it had some sentimental value to her. So she changed the name of the business to something else that was kind of already branded a certain way with their business. So it made sense. But then, she's also kind of shopping for brokers and potential buyers for the business. But along the way, she's just kind of keeping up on things and making sure everything is up to date so that, if and when that buyer comes along, she's ready to go. Um, and then, as your business evolves, just making sure that your structure is appropriate and your documents are up to date to reflect that structure. Um, and knowing that that is an option that you have to change it. And the question about having moving from one jurisdiction to another, that's also, a question to keep in mind is like, where are you going to be based? You personally, where are you going to be based and where is the company going to be based? It's going to be in line with where you personally are going to be. And we have a lot of military families in this area, so people move around a lot. Um, but your business doesn't have to move around with you. There are ways to kind of think through on how to handle, any moves, or even like we have people that work in the State Department, or spouses in the State Department, and they might get posted overseas, but their business is still in the US. So, things like that in terms of planning ahead on what your business, how your business is going to look, where you're going to be, in the near term. Things like that can affect, how you're going to maintain your business, but it's something to kind of keep in mind, um, as you go along and make sure that, things are in order. I'm going to pause there and see if we have any questions.
Thank you. We absolutely do have some questions. First one is for
Great.
those looking to apply to local business grants, what type of LLC would be the best for an early startup that is not yet generating revenue and still in the pilot slash proof of concept phase?
So I would say, in terms of type of LLC, there's really one type of LLC, and whether you're a single member or a multi-member, it just depends on how many owners own that LLC. So when you go to register the LLC with the Virginia Corporation Commission, um, that there's just one type that you register for. It's just LLC. And then, whether or not there are one or more members, that's just kind of internal to the LLC. And you don't necessarily have to report that to the Virginia Corporation Commission. Um, I would say, if we work with a lot of folks who are in the proof of concept phase who haven't gone to market, they're still developing whatever they're developing, but they might go ahead and create the LLC so that, any sort of costs that are associated with that activity are, with the LLC, and you kind of already separate that. And then, um, potentially, if there's any sort of liability, it's also separated so that it kind of gets covered by the LLC, and it won't affect your personal assets. So even if you are pre-launch, pre-market, as you're preparing, consider putting, creating the LLC and, conducting all of your activities out of that LLC. And then any money that you put in personally, that's kind of capital that you're contributing into the LLC because you're not, getting money out of it yet. But that's a way to kind of keep track of, your costs and also limit liability for any kind of pre-market activities that you have.
Thank you. Um, do you need bylaws if you are an LLC with an S-Corp tax election?
No. So the governing documents will follow, your entity type. So if you are an LLC that is elected to be taxed as an S corporation, you just have your operating agreement. Bylaws are the governing document for corporation. So, something that is created as a corporation.
Thank you. How do you prove business assets versus personal assets for liability purposes when you are operating as a single member LLC? Would that be with a balance sheet?
Um, yes, it would be, that would be a written proof, but, you also need to know what what you are considering a business asset versus a personal asset. So let's say you have a laptop, and you use it for personal and business. Are you considering it a business asset? If you are, then, let's say I start an LLC and I'm going to, say that the laptop is a business asset. So yeah, it'll go into the balance sheet as, equipment, and the laptop is in there. So you just have to know for yourself what is, a business asset versus a personal asset, and then you do the accounting appropriately, or the bookkeeping rather.
Thank you. And I do want to just flag that we have a webinar coming up on June 24th. That is, you've got the business, now let's organize the finance. That can speak to some of those similar questions about filing taxes, what's considered a business versus personal asset, basic bookkeeping type questions. So I highly encourage folks to register for that. Next question. If you are a single member LLC, do you have to file an annual report or just pay annually for your renewal?
So in Virginia, it's just a renewal fee. I don't believe there's an annual report, but if you're in another jurisdiction like DC, they have biannual reports. So you actually have to file something and pay a fee. So it'll be jurisdiction dependent, and you should be getting notices from Virginia SCC about when your filing fee is due, your renewal fee is due. But you can also look it up on your entity record on the Virginia SCC registry, and it'll say, annual fee is due or not due, and the deadline there for you.
Thank you. Could you speak to transitioning from an S-Corp to an LLC? Question asker says it seems like it would save on taxes and registration fees.
Yeah, so the tax savings, that is going to be an accountant question, and it's going to be dependent on your actual numbers and situation. The registration fee, that's negligible. I mean, there's not a registration fee for um, being taxed as an S corporation. You have to file a Form 2553 to elect to be taxed as an S corporation, but there's no fee associated with that. You're just telling the IRS, I want to be taxed this way. And then you do your books that way for the year and then file your taxes that way. Um, yeah, so it's transitioning back, because the default when you form an LLC is the pass-through, and then you would have to have elected to be taxed as an S corporation in order to be taxed as an S corporation. Transitioning back is, I would say, less common, because typically, you've made the election because it will save you on taxes. Um, so talk to your accountant about specifics on the tax savings aspect of it. But it does require some unwinding of things, including, whether or not your owners are paid as W-2 employees. So I think, typically I don't see it go the other way around. From S Corp to back to default is that, you're generating enough income so that your owners are able to make a salary from the um, from the company. So, yeah, in terms of like how much your compensation is versus how much you're taking as a business owner, that you can, figure out what the optimal compensation package would be between those two, but that is going to be really specific to your situation. So I would say talk to your accountant.
Thank you. Could you go back to the slide that is the red flags, please? We had a couple folks
And
asking for that.
the due diligence one, I think it's this one. Is there a specific question about the
Uh,
slides?
Not that I'm seeing in the queue yet, just asking to look at that slide again. So we'll move on to the next
Okay.
question.
Yeah.
And question asker, please, if there's a question that's from this slide, let us know.
I mean, this is not an all-inclusive list, I will say that, but these are generally when I am on the side of, the funder or the investor, I will send a long list, or perhaps a business purchaser. I will send a long document of due diligence questions, and these are like kind of the headers for each category of thing that I will be asking about with respect to that business. Like, I want to know what the revenue potential is, what the health of the business is, what the risks of the business are. So these are just kind of like the top line categories of things, and then it has questions underneath each of these categories.
Awesome. Thank you. So I think we did have another clarifying question about whether S-Corp filing, just again clarifying if S-Corp filing is solely for tax purposes. And I think you've answered that
Yeah.
question a couple times. But if the question asker is still confused, I will be sending out the slides so that you can look through all the information again. And if you still have questions after that, please do send us an email.
Mhm. And that is
So
a one-time filing. So you make the election and then that's how you're going to be taxed from there on out, unless you change it. So it's, just a one-time filing, and it is if you want to be taxed as an S corp. And yeah, that's essentially it.
thanks. So I've only got one more question in the queue. If folks have any that they've been holding off on submitting, please do send those to the Q&A so we can get those addressed since we have a little bit more time today in our session. When is there a requirement to get a state EIN? The question asker's consulting business is a sole proprietorship LLC with no employees, but hoping to grow next year and hire some employees.
That's a great question. Virginia is a little bit unique. Um, well, rather, states will treat it differently. So in Virginia, Uh, if you do not, if you are a single member LLC that is taxed as a default entity, and you have no employees and you do not sell any tangible goods, then you do not need to get a Virginia state tax ID. That means you don't have to register with Virginia Tax. Um, if you any of those things change, like you hire employees or you make an S corp election, or you have add another business partner, you have to then get a Virginia tax ID. In DC, for example, you always have to get a DC tax ID, no matter what. But Virginia, you can, if you are, again, a single member LLC, tax as a default, no employees, no tangible goods sold, so you're doing consulting services, or other kind of knowledge work, no registration with Virginia taxes required.
Thank you. I am not seeing any questions left in the queue. So I wasn't sure if you had any more slides to go through, Tammy, or any other kind of key things for folks to be aware of, or most common questions that you can get with regards to this topic.
Yeah, I think that's pretty much it. We covered a lot of good questions that have come up that weren't necessarily in the slides. But I do have, in addition to what Allie was offering through Capital Pathways, we do offer consultations if you'd like to talk to me one-on-one. Of course, Capital Pathways is a partner of ours, so you can go through Allie and be set up with one of their advisors. And then if you need legal assistance as well, she can also loop you back in with our team at the Geller Law Group.
Thanks. We did have another question come in, so we'll answer that before we close out.
Okay, great.
If one is a sole proprietor of several rental properties, is a good liability protection alternative to establishing multiple LLCs? I think we've already addressed this question. It's asking similarly about um, alternatives to establishing multiple LLCs or other forms of ownership using high levels of insurance as an alternative to establishing LLCs to cover any lawsuit judgments. And I believe, question asker, I did encourage you to reach out to us via email about this because it is fairly specific. But
Mhm.
Tammy, if you wanted to take a stab at it, please.
Yeah, I mean, this is definitely a question that comes up in terms of rental LLCs. More in the context of if you have one LLC, like, do I need to establish an LLC because, once you create an LLC, you kind of have to keep it alive, maintain it. You pay the annual fee and then all of the registrations and licenses associated with that LLC. So there is a bit of an administrative burden to having an LLC. And of course, as I suggested earlier, having multiple LLCs, if you have one per property, that also adds to the administrative burden. So often people will say, like, can I just get insurance? Um, yeah, sure. You can definitely get insurance to cover that. I would always suggest insurance anyway. But what I typically tell folks is like, in terms of liability protection, I see it as a three-pronged approach. One is to have the business entity because that gives you the protection by separating your business assets. So in this case, your rental property from your personal. Secondly, is to have insurance that if there is a judgment or a claim, that the insurance will respond to that claim by helping you pay for legal costs to respond to it. And then if there's a judgment, like you're found liable, then it can help pay out that that um that judgment so that you don't have to like dip into the LLC's assets to pay out any sort of judgment. Um, and then third prong to this liability protection is a good contract. So, if you're renting out the property, having a strong contract to help with the liability protection, that'll help you from even, getting to the lawsuit where, you're found liable for something that you weren't expecting to be your responsibility. It should be addressed in the contract, hopefully, in terms of how, common circumstances are to be handled or disagreements or, accidents or things of that nature that should be handled in the contract. So, um, so insurance can't necessarily replace all of those things, but you can choose to forgo the business entity if you are okay with having your personal assets at risk. Um, usually if your insurance is going to have limits on it. So you want to make sure your limits are high enough to cover whatever potential liability. Otherwise, your personal assets could be subject to the claim. So it is a way to go. And it'll, the call is up to you. I typically will tell clients, I'm providing you with the information for you to make the decision that is going to work best for you. So that is, typically how I would explain it to somebody who's asked that question on, can I just have insurance? And that's fine. You should still have a insurance and the contract, but and a protective contract in place. But make sure your limits are going to cover in amount and the types of potential claims that you could have coming out of the rental property. So, yeah, just and I would also recommend using a broker so they know exactly what you are doing as far as the rental goes, and they can probably advise you on what your insurance policy is going to cover, and so you can put any sort of like prohibitions into your rental contract with whoever you're renting it to. So that's another way to like kind of maximize those two items.
Thank you. Alrighty, so with that, our time together has come to a close. Thank you everyone for the excellent questions and for joining us today. We hope to see you in future webinars. And thank you so much to Tammy for all of the informative guidance and resources.
All right. Thanks, Ellie, and thanks everyone for spending time with us today. Have a great weekend.